Nashville. I am Beau Beach. This is the Free Speech Podcast. We are going to share with you the top 10 stories of the week. As always, brought to you by Beechwood Commercial Real Estate Brokerage, your broker if you are a seller of commercial property in Nashville or the Southeast. I'm going to give you an overview of the stories we're going to cover in today's podcast, and then we'll get into it. First, Robert's Western World on Broadway to expand. I'll share with you that story. Thompson Station getting a huge mixed-use development from a big Atlanta-based company that is known for its downtown Nashville acquisitions. So Sleepy Thompson Station has now attracted one of the bigger, more active developers in the area. I'll share that with you. Nashville, among the cities with the highest home price increases over the past decade. I'll let you know which other Middle Tennessee cities made the list and how Tennessee as a state shaped up in that ranking. Gallatin Pike to receive an innovative new development that I think is worth sharing. Big Lots is now selling off its leases. This is an interesting development whereby leases have value because of the low vacancy rate in retail across the country, but especially in Nashville. An unusual scenario that I think is worth discussing. In a related news, Joann Fabrics, now known as Joann, declares for bankruptcy. Many of those stores also now to be available. TPAC is still looking for a new home. I'll explain to you how their search has changed. Advanced Auto Parts is now also unloading stores. So one of the themes of recent podcasts has been how many retailers are either failing and going bankrupt and liquidating or substantially downsizing. In a market with very little retail vacancy, this is welcome news to many retailers. Next, a Brentwood office building heads to foreclosure auction. Very unusual to see that, especially in Williamson County. It hasn't happened in a long time. A huge loss on that property. I'll let you know how that turned out. 12 South, first full-service hotel, a very innovative concept coming to 12 South that we'll discuss briefly. And then an interesting story. The world's largest teardown is said to be coming in all places of failing Chicago, Illinois. The numbers in this story are staggering, and I'd like to put in perspective for you just how far Chicago has fallen. They're about to set the record for the largest teardown in world history. Let's get into it. Robert's Western World to expand. Renovation plans are underway for longtime honky-tonk Robert's Western World. They will add an additional floor, restaurant, and private rooftop terrace to the Broadway building. The second floor will offer a new restaurant concept from the Roberts ownership team, and the third floor addition will provide a new kitchen, office space, and a private rooftop terrace. So Roberts itself not changing, the building changing, adding a restaurant, adding a kitchen, adding a private rooftop terrace, and of course adding a little office space for the folks that are going to manage it. So it's nice to see Broadway continue to improve. Robert's Western World is joining the group that is pushing downtown's Broadway into the next decade. Next, Thompson Station gets a huge mixed-use development. So we don't hear a whole lot about big, active, well-capitalized developers moving from Broadway to Thompson Station, but that's exactly what we've got going on. An Atlanta-based real estate investment firm known for its lower Broadway purchases is heading to the suburbs for its 12th Nashville area acquisition, the Ardent Companies, to transform 100 acres of Thompson Station into a multi-million-dollar mixed-use destination. Located at the southwest intersection of Interstate 65 and Interstate 840, a great location. Everyone knows where that is. Rezoning and site plans still need to be approved by the town. Ardent purchased the property for $15 million in December. When complete, the site will be home to a mix of retail, hotel, multifamily, townhomes, and single-family residential properties. They said, multifamily becomes more valuable because they have walkable grocery stores, retail shopping, and entertainment, and vice versa. Since 2014, Ardent has invested over $300 million in Nashville. However, this acquisition marks their first outside of downtown. Past deals include $61 million investment in JBJ's and a $28 million purchase of the former George Jones Museum, now home to the 5-level entertainment complex known as Nashville Live. Though it's a first for Ardent in Nashville, mixed-use development investments are the company's bread and butter in other markets. So this is a very well-capitalized, very capable developer who has been splashing money around Nashville that's now going back to their bread and butter mixed-use developments, and they've chosen Thompson Station, of all places, for that first development. I think this is going to be a huge hit. That is a great location. Williamson County is hot, will be hot for the foreseeable future. I think this is going to do really, really well. I think it's going to be an impressive development whenever it gets done, which will be years and years away. All right, let's take a brief detour into the residential real estate business. I want to put in perspective for you how much prices have changed in Middle Tennessee. Nashville among cities with the highest home price increases over the past decade. Some might conclude we are at the top of that list, but in reality, Nashville comes in at number 9 among large cities with a 136% increase in median home values over the last decade. That means in 2014, the median home value was $181,000 and it has since jumped to $429,000 in 2024. So 136% increase doesn't sound like too much until you realize that means going from 181 all the way to 429 in 10 years. Murfreesboro also made the list at number 26 amid mid-sized cities with a 130% increase. Statewide, Tennessee saw a 10-year increase of 122%, landing in the number 8 spot for the states. I'm going to give you the cities that were ranked higher than us on this scale, and I'll tell you the first one is a shocker. Detroit, Michigan had a percentage price increase of 203%, which only amounted to $50,000 in changes. So Detroit started at such a super low price. They could go up by 200%, and that means an increase of $50,000 over 10 years. But the others on the list make more sense. Tampa's at number 2, Dallas at number 3, Phoenix at 4, Columbus, Ohio at number 5, Charlotte, North Carolina at 6, Milwaukee, Wisconsin, which I would have never guessed was in the top 10, is at number 7, Cleveland, Ohio at 8, and then of course Nashville comes in at number 9. Nationwide, home prices have increased 95% in the last 10 years, while the average hourly earnings has risen only 44%. And that, folks, is why you hear housing is so expensive. Housing up 95%, wages up 44% over the same period. It is difficult to afford houses. It is even more difficult to qualify for financing. So people that are not in the real estate business, I think, gloss over the importance of the availability of financing. That has been the number one challenge in the commercial real estate market over the last 3 years. Banks simply aren't lending to folks that want to borrow. They're only lending to people that don't really need it. So until the banks loosen up and start making it easier to borrow money, many of the problems we're experiencing both in the residential and the commercial side are not going to correct themselves. We need to get easier access to financing, and that is my hope of what we're going to see in 2025 as regulations are loosened up, as banks are encouraged to start lending money again. I'm hopeful that more and more people are going to qualify for financing, myself included. I'd like to think I'm a pretty successful guy. It's even hard for me to go out and borrow money in the marketplace today. And there are a lot of super successful people that would say the same. It's just a difficult thing to do. If I could get any wish granted in 2025 with the Donald Trump administration, it would be encourage banks to lend money, give them the freedom to lend money, reduce regulation that prevents them from lending money. Let them be a business that lends money to people who they believe will repay it. Loosen it up, make it easier. Let's get the money flowing again. Let's borrow money to folks that we believe will repay it, and let's get this economy going again. That is my dream for 2025. That would help me personally. That would help my business substantially. Next, Big Lots is now selling leases. And this is an interesting thing, right? So a lease is an obligation to a landlord, from a tenant to a landlord, right? So you have a lease, you're paying that landlord every month to use that space. But now, since the nationwide vacancy rate for retail property is down to 4%, at least in Nashville, right? Nashville retail vacancy, 4%. There is demand from businesses who want to occupy retail space but can't find it. They will actually pay you to take over your existing lease just to find some vacancy. This is unusual, but it's starting to happen a lot. It's happening with Big Lots now. It's happening with Joann Fabrics. It's happening with Party City, which we've covered in previous weeks. So it's an interesting phenomenon. A new batch of Big Lots store leases, about 500 nationally, has hit the market and is being sold by the chain's new owner, Gordon Brothers. Quote, "There's a tremendous amount of value in this portfolio. It's like no other. It's incredibly well managed with long-term leaseholds. It presents really a once-in-a-generation opportunity for an occupier to expand its portfolio quickly." So if you want to get into retail space in locations that you've had a hard time getting into, the idea is you can pay a premium to do so and do so quickly. Gordon Brothers is selling 200 to 400 Big Lots store leases to Henderson, North Carolina-based Variety wholesalers, which will continue to operate them as Big Lots locations. This is in addition to the 500 that are now available to purchase nationally. The locations range in size from about 19,000 square feet all the way up to 55,000 square feet, which is a huge range. As part of the Big Lots asset sale, Gordon Brothers got 903 total store leases. With the U.S. retail vacancy rate at a low of 4%, chains are hunting for spaces for new locations. So that's an interesting thing. You would think that all that demand for retail space would benefit the property owner that could provide that retail space. But what's happened, at least in the short term, it's actually benefiting the occupant. The occupant that can no longer stay in business is flipping those leases, selling them, profiting from them, just so that the buyer of those leases, the new occupant, will take over their obligation and start making those rent payments for them. It's unusual. In a related story, Joann, formerly known as Joann Fabrics, declares bankruptcy. Craft sewing chain Joann is in bankruptcy court a second time, along with Party City, as the U.S. retail industry continues to see a shakeout. Gordon Brothers Retail Partners is the stalking horse bidder for the chain, looking to acquire the troubled company's assets as it did with Big Lots. So the buyer of Big Lots is now targeting Joann Fabrics. It's not a done deal yet, but they are the stalking horse bidder. But in this case, Gordon Brothers has indicated it intends to liquidate Joann and conduct going out of business sales at all the stores if it is ultimately the buyer. Joann, an 80-year-old chain, plans to continue operating its roughly 800 stores, all leased in 49 states in the interim. Joann first filed for Chapter 11 in March of last year. Joann's post-bankruptcy comeback was stymied in part when it faced inventory challenges or less merchandise because of issues with its vendors. So it's filing bankruptcy a second time. The first time it filed was in March of last year. That did not play out the way they saw it going. So after they declared bankruptcy the first time, it seems to me like they didn't treat their vendors very well. Perhaps those vendors had to take a haircut as part of that bankruptcy proceeding. And those vendors just said, listen, we're not providing you any more products. So Joann actually reopened stores, but with much less product. So there wasn't a huge selection, which really hurt them in terms of sales after that first bankruptcy. Joann had very little room for error when it came out of Chapter 11 last year. When Joann emerged from bankruptcy last year, it did so with breathing space rather than a complete solution to all its problems. While it reduced its debt burden, it did not eliminate it. The experience in many stores is subpar, which damaged sales. If Gordon Brothers wins the bidding, then they will basically liquidate the business to get a return. That might mean selling off the brand, the intellectual property, and some of the stores. Or it may be more radical with all stores closing. It depends on the interest. But Gordon Brothers had a different outcome when it acquired the assets of Big Lots. It found a buyer for between 200 to 400 Big Lots stores, keeping the chain alive. Gordon Brothers is now in the process of selling leases for around 500 of those Big Lots stores. We just covered that, right? So a little bit of redundancy there, but I think it's interesting when these retailers go out of business or they declare bankruptcy. It's interesting what these buyers see as assets with value. So they buy all those assets, even leases, which are generally thought of as a liability, not an asset, right? A liability, you're the one that's got to pay for it. But now, because of the low vacancy rate across the country, those former liabilities, those leases, are actually treated as assets that have value that these buyers can sell off one by one in an effort to create a return for themselves. TPAC is still looking for a new home. Nashville Mayor Freddie O'Connell isn't walking away from talks to build a new Tennessee Performing Arts Center on the East Bank, despite newly public drama injected into those negotiations. The board members of TPAC decided at a January 13th meeting to explore alternatives after hitting what leadership described as a breaking point in their dealings with Metro. TPAC had been targeting a site for a new venue costing at least $600 million at perhaps the most prime spot on the East Bank. The 3.3-acre waterfront site sits at the base of the John Siegenthaler pedestrian bridge. Sorry about that. That's a tough one. That is not catchy at all. Which would effectively become the entryway for a revitalized East Bank. That also will feature a new stadium for the Tennessee Titans and a mixed-use development. Quote, TPAC has long sought a lot on the East Bank that is the most expensive to develop because of its proximity to the pedestrian bridge. It's not clear to me why it costs so much more to build near this pedestrian bridge, but nevertheless, that is kind of accepted as true. TPAC would actually be entering a ground lease for the site, so they would not own the ground. They would make a monthly payment to use the ground. TPAC has to find a new location because the state, which owns the building currently home to TPAC, is emptying that facility and plans to lease or sell it to a developer. The state previously announced $500 million of funding for TPAC to spur its relocation and help build a new venue. That full amount is contingent upon the state approving the money in its budgets, as well as TPAC reaching a donor fundraising campaign target of $100 million. So if TPAC can come up with $100 million, the state's going to chip in $500 million. The nonprofit was closing in on $40 million of donor funds pledged towards the project, so they're yet to raise the $100 million needed. Higher infrastructure costs would appear to add to the total amount TPAC needs to come up with for the proposed project. So the idea is TPAC would love to be at the base of the pedestrian bridge. They're having a hard time raising $100 million to do that deal. And now, because those infrastructure costs are so much higher than anticipated, they'd actually have to raise more than $100 million, because the $500 million giveaway from the state, it still isn't enough to get that project done. So it'll be interesting to see how that plays out. They may have to look at other sites in an effort to work within that $100 million fundraising that they had initially proposed. Again, another retailer unloading stores. Advance Auto Parts is now unloading its stores. More than 200 Advance Auto Parts stores, either the properties themselves or their leases, are being marketed for sale. Another retailer selling leases. Raleigh, North Carolina-based Advanced Auto and Auto Aftermarket Parts retailer. The portfolio includes retail locations and potential redevelopment parcels situated in densely populated urban areas and along strong commercial corridors. The properties and leases in the portfolio can be sold together, individually, or in any combination. Gordon Brothers is marketing leases for around 500 Big Lot stores, and nearly 700 Party City store leases are being auctioned by A&G Real Estate Partners. Again, we've covered this, but this is very, very interesting. This is uncommon that you'd have so much demand for retail space and so many retailers failing. It's created a situation where these leases, which are generally thought as liabilities, are now being marketed as assets with value. It said it would be closing more than 700 stores and shuttering 4 distribution centers. The company is one of a variety of retailers, including Macy's and drugstore chains such as Walgreens, that are trimming their store fleets to cut costs and boost profitability. Their stores range in size from 3,000 all the way up to 48,000 square feet. Again, a huge range. The leases have an average life of 5 years of remaining fixed term on them. So again, I think we've spoken enough about how unusual that situation is, but I think it's just not something we see every day. It's worth discussing. Brentwood, a very, very highly sought after location for office, has got a very high profile foreclosure on its hands. The West Park building, a 5-story office building in Brentwood's Maryland Farms, will go up for sale at a live foreclosure auction on January 16th, which has since passed, and I'm going to give you the outcome of that auction in just a moment. The office building is currently owned by First National Bank of Tennessee, which acquired the property from Brentwood-based investment firm Crestview Funds through foreclosure. Crestview paid about $25 million for the building in December 2013, which is interesting because 2011, 2012, 2013 were ideal times to purchase commercial real estate. That is generally thought of as the bottom of the market. Built in 1982 and offers nearly 100,000 square feet of office space on a 5.14 acre lot, the property has been vacant since late 2024. Therein lies the problem. They lost their tenant or their tenants, and as soon as all of those bills come due and you've got no income coming in, that is hard to handle if you aren't well capitalized. And do you want to handle it if you're realistic in realizing that you've got $25 million in this property? It's worth much less now. How much more money do you want to put into this bad investment? In those scenarios, that's when the keys get turned over to the bank, which is what happened here. The auction will be held live at the site of the building, which is cool. I like the idea of auctions being on site. Commercial foreclosure activity is on the rise across the country, likely due to rapidly rising interest rates, in addition to inflation and changing demand for commercial real estate, most notably offices. Now, let's get into the outcome of that auction. Brentwood office building sells at foreclosure auction for an $18.5 million loss. The building sold for $6.3 million to a local investor. That marks an $18.5 million loss from what it sold for in 2013. The auction attracted 29 bidders, which is a very, very active auction. The buyer is an investor and contractor based in Brentwood. They plan to renovate the property and return it to the leasing market. So, $18 million loss, primarily driven by losing the tenants, right? So office buildings historically are valued by the cash flow that they generate, right? So if you lose all of your revenue, your cash flow goes negative, that property is virtually impossible to finance. So now you're really talking to only cash buyers. And if your only buyers are cash buyers, get ready for the haircut you're about to take. And that bank took a big haircut. So the buyer lost all of their equity. The bank lost, I don't know, probably $15 million on the loan. It trades for $6 million, and it's going to be put right back into service as an office building after getting a little bit of a facelift. I'm sure the investment will work out just fine for the buyer, and I'm also sure the seller is absolutely sick about putting in 10 years of work only to lose their entire equity investment. Let's move on to a more positive story. 12 South's first full-service hotel. Nashville-based M-Cube Developments is nearing completion on the Gilmore, which will be 12 South's first full-service hotel with units ranging from studios all the way up to 4 bedrooms. That's an interesting idea for a hotel. A courtyard, rooftop, and common areas for guests. With our versatile guest rooms and private event spaces, we're excited to fill a real need in this corner of the city. Interestingly, M-Cube originally planned for the building to offer condo units. It changed its plans after it had early and significant construction delays. It chose to move away from the condo concept into a very, very unique 4-bedroom hotel concept. I think this will do real well. I love hotels that aren't just studios, right? I love hotels that have separate bedrooms, and they're hard to find. I think this project will do real well. And last, the world's largest teardown potentially coming in failing Chicago. Listen to this story. One of the city's tallest skyscrapers is set to sell for about $70 million, a steep discount from the last time it changed hands. More tantalizing is the long shot prospect that the sale of the 65-story office building could lead to the biggest voluntary demolition in world history, erasing a prominent part of the skyline. This building is more than 1.3 million square feet, located at 311 South Wacker. It last sold for $302 million in 2014. Again, that's an area of the market, a time of the market where properties were selling at reasonable prices. $302 million about to trade for $70 million. That is the state of Chicago. That is what happens when you are managed so poorly by your local government that businesses are fleeing. They have the politicians in Nashville, mind you, the politicians in Chicago. Mind you, I once lived in Chicago. My wife is from Chicago. I actually managed huge skyscrapers like this one in Chicago. This was many years ago. This was, 20 years ago. Chicago was cranking 20 years ago. Today, it's absolutely failing, and it falls at the feet of the Democrat politicians which have dominated Chicago politics for so long. The crime, the homelessness, the overtaxation, the overregulation, the unions. 20 years ago, even the unions were a big problem. So any type of construction project you need to get completed in downtown Chicago, just assume it's going to cost 40% more than it should because you're forced to use union labor. So there were problems in Chicago back then, but the problems today are significant, and it's hard to imagine really Chicago really coming out of this tailspin. They have been so mismanaged. Anyone that has the ability to leave has left. And what you've got left is $302 million skyscrapers trading for $70 million just to be torn down. One scenario for 300 South Wacker would be working with Houston-based Hines to tear down the tower. If it were to come to that, demolition crews would eliminate a 35-year-old building that has underperformed in the Chicago leasing market while creating a full block parcel that eventually could include multiple new skyscrapers with well over 4 million square feet of space combined. That would be a very risky bet, but maybe they know something I don't know. Demolition could cost tens of millions of dollars beyond the acquisition cost, potentially adding to a total investment of $100 million or more just to clear the site and start over. If it were to happen, it would become the tallest building in the world history to voluntarily be torn down. And I'm sure Chicago is not happy to be setting that type of world record, but it's got so many problems there, guys. I've still got extended family there. I've got friends there. The situation in Chicago is absolutely pathetic, and it shows no signs of getting better. In fact, it shows signs of actively getting worse. If you ever find yourself feeling that your property taxes are too high, too burdensome, I encourage you to compare what you're paying to what the same property owner would be paying in Cook County, Illinois, which is the home of Chicago. In Chicago, if you are to buy a property, you put 20% down, you get an 80% loan-to-value loan. Every month when you get that bill, if you're escrowing for insurance and real estate taxes, your monthly bill, you're going to be paying more in real estate taxes than you are for that mortgage. So your monthly real estate tax payment is higher than your monthly mortgage payment to live in an unsafe, failing city. If you can figure out why anyone would want to do that, please let us know, and we will share it live on the podcast, because that is absolute insanity. I know there are people that can't leave. They say, my family lives here. They say, well, my business is here. I can't just relocate my business. I get it, y'all, but at some point you need to liquidate some of your assets and get the hell out of Chicago. Have some common sense. They are going to run that city into the ground. You are almost there. And they continue to increase taxes. They continue to increase regulations. They continue to let crime run unchecked. They continue to let homeless people stand on the corner, slay in front of $100 million office buildings. No reasonable person wants to deal with any of that. And I will tell you, Chicago is in real trouble. And the idea that they're going to spend $100 million to knock down a skyscraper, 65-story skyscraper, just to build something bigger, I'm not sure I buy it. I think somebody is going to come to their senses and say, man, this is way too risky. Why would we ever think that anyone wants to live in Chicago? Why are we going to put all of this capital at risk? I'm not sure this deal gets done. I'm not sure any of that full block development ever happens again. I think Chicago is very much on a downward trend and will continue to be on a downward trend for the foreseeable future. I think it's untouchable for real estate investment. I think you are going to see more and more losses taken just to get out of that market. But, I quit doing business in Chicago a long time ago when it became so hard to sell commercial real estate there because of the burdensome real estate taxes. You market a property in Chicago, commercial property in Chicago, every buyer, the first question they ask is related to real estate taxes. What are the real estate taxes now? If I were to pay your price, what are the real estate taxes going to be after I become the owner? And they get those numbers and they think, that is insane. I would never buy this property. And, in the back of my mind, I was thinking, I totally agree. No one should buy this property. There's no reason to buy commercial property in Chicago. It doesn't make any sense. And that's why you're seeing 65-story skyscrapers being discussed for demolition. It is a real situation. So if you need an update on how well we're doing in Nashville, if you need a perspective shift, as I talk about a lot, just compare what we've got going in Nashville to what they've got going in Chicago, and all of a sudden you're going to feel better about yourself, your position in life. Life is good. We're not in Chicago. We're in beautiful Nashville, Tennessee, where we're growing, where we have limited government, where we have low taxation, low regulations. Could things be better at the state level? I agree. They could be better at the state level. But for the most part, we're doing pretty well. I would also mention, I was really disappointed with how the state and local governments handled the scamdemic known as COVID. I think we really underperformed during COVID. Instead of just following the crowd like a bunch of sheep, we should have been free-thinking people that make decisions for ourselves. We should have left our economy open. We should have left our schools open, and we should have let each individual make the best decision for them and their families. We do not need the government telling us what we can and cannot do because there is a new glorified flu virus with a 0.01% chance of death. That was a big failure. I think we're probably going to have some changes at the state level when those elections roll around. And I hope the next person is going to have the courage to stand up for the people of Tennessee and not just follow the crowd. All right. Well, that's the end of the day's show. Again, presented by Beechwood Commercial Real Estate Brokerage, your broker if you are the seller of a commercial property in Middle Tennessee or the Southeast. If you are considering selling a property in 2025 and you'd like us to walk you through exactly what that would look like, I encourage you to reach out. Let's start that conversation. Until then, we'll talk to you in 2 weeks with another episode of Free Speech with Beau Beach. Thanks so much.